All right, let's dig into a concept that is honestly a real game changer. We're talking about what separates traders who are just spinning their wheels from those who are consistently profitable, and it all comes down to understanding the real points of interest, the ones smart money is actually targeting. So let me ask you a question. Have you ever had this happen? You find what looks like the most perfect textbook setup you've ever seen, a super clean order block, a clear break of structure, and you think, this is it, only to watch the price just blow right through your entry and smash your stop loss. It is one of the most frustrating things in trading, and believe me, there's a very specific reason it keeps happening. I'm sure this looks painfully familiar. On the left, that's the dream, right? Price comes down, gives your zone a little kiss, and flies off in your direction. But on the right, that's the reality for so many of us. A brutal stop out that just leaves you scratching your head wondering, what did I miss? So what is really going on here? Well, the answer lies in a core market concept that, honestly, a lot of traders just completely overlook. And that brings us right to our first section, the order block trap. Okay, so here is the secret you need to burn into your brain. Most of those obvious, clean-looking order blocks you see on the chart, they are not reversal points at all. They're bait. They are intentionally created as inducement. Their whole job is to trick you and thousands of other traders into placing orders there. Why? Because that builds up a nice big pool of liquidity that the market can then go after. And why does it do that? Well, this quote from the channel Smart Risk absolutely nails it. The market needs fuel to make big moves. It needs liquidity. And those obvious order blocks, the ones packed with everyone's stop losses, that is the fuel. The market isn't aiming for your zone to reverse. It's aiming for the pool of money sitting just on the other side of it. Okay, so if most of these order blocks are just traps, how in the world do we find the real zones? Well, that's where this next part comes in. It all comes down to understanding the secret of liquidity. This is the key difference right here. A true high probability point of interest, or POI, isn't just a leftover order block. It is a zone that was created by a liquidity sweep. Think of it like this. It's the footprint the market leaves behind right after it has already grabbed its fuel. That's the spot we're interested in. So what does this actually look like on a chart? Let's hunt for a bullish POI. It's really a three-step process. First, you find that last down candle right before a huge move up. Second, and this is the most important part, you have to confirm that this candle's wick actually dipped down and swept the liquidity sitting below a previous low. And third, you validate it by seeing the price immediately reverse and shoot back up. That liquidity sweep, that's everything. And for a bearish setup, you guessed it. It's the exact same logic, just flipped upside down. You're hunting for that last up candle right before a big drop. You need to see its wick poke above a previous high, grabbing all that buy-side liquidity. And that immediate sharp reversal back down, that's what tells you you've found a high probability zone. Okay, finding the right zone is a massive leap forward, for sure. But, and this is a big but, it's only half the battle. Just because you found a great spot on the map doesn't mean you should just jump in blind. That brings us to the next critical piece of the puzzle, waiting for the signal. Here's a really simple but incredibly powerful idea. That move back to your POI, the retracement, that isn't just random noise. If you were to zoom into a lower time frame, that pullback is its own valid trend with its own highs and lows. And what's the first rule of trading? You don't fight the trend. So this means you have a choice. You can go the high-risk route and just slap a limit order on your POI, hoping that this little retracement trend just stops on a dime for you. Or you can take the higher probability path and wait for the market to give you actual, concrete proof that the pullback is over and the main trend is ready to take over again. So what is this proof we're looking for? It has a name. It's called a change of character, or you'll often hear it called a chuck. All this is a simple break of market structure on your lower time frame, say the 1 minute or the 5 minute chart, that happens right inside your higher time frame POI. It is the first clear signal that the pressure from that pullback is finally exhausted. So let's put these two massive secrets together now, liquidity and confirmation, and combine them into one simple, powerful process. This is what we call the two-step confirmation framework. This is it. The entire strategy boiled down into two simple steps. Step 1, on your higher time frame, like the 15-minute or the 1 hour, you identify a point of interest that has already done a liquidity sweep. Step 2, you drop down to a lower time frame and you patiently await a change of character inside that zone. And the rule is simple: no chotch, no trade. Period. You see, the real power of this approach is that it stops you from trading based on just a location. Now you're trading with context. That comes from the higher time frame liquidity sweep, and with confirmation, which comes from that lower time frame shift in structure. You're reacting to what the market is actually doing, not just predicting what you hope it's going to do. Okay, so let's wrap all this up and talk about how you can take this framework from just an idea and actually apply it to your own trading, starting today. If you walk away with nothing else, please remember these core ideas. Number 1, liquidity is the fuel. Always be asking yourself, where is the market likely to go hunting for fuel? Number 2, patience provides probability. Waiting for that confirmation is what will boost your win rate. And finally, remember the roles of your time frames. The higher frame gives you the context, the where, and the lower frame gives you the confirmation, the when. But there is one last absolutely crucial step that both our sources really hammered home. Before you ever risk a single dollar on this strategy or any strategy, you have to prove to yourself that you can actually execute it. The recommendation? You need to go back and backtest this approach at least 100 times. So there you have it. You now have the framework to stop falling into those liquidity traps and to start trading high probability zones with real solid confirmation. The only question left is the one right there on the screen. You have the framework. But have you tested it?